turn the news off. Turn CNBC off, Fox Business, Bloomberg, I don't care what the source is. The problem there is they're all going to sell the fear narrative. All right, hello again, everybody. This is Mike Rixey with Netpicks, and in today's video, I want to take a closer look at the past few days of trading. It has been a stretch for the record books, no doubt about it. I've been trading now for over 20 years, and we've seen things this week that I've just never seen before. It has been a wild ride in both directions. So we'll take a look at some key levels that are jumping out at us for this afternoon, trying to determine, is this a near-term bottom? Are we going to see further price action on the upside in the coming days? Or is this just a relief rally that's going to be sold yet again? That's been the story over the past week or so. We'll also take a look at a trade that we just closed out of this morning for a quick profit. And we'll also break down a trade that we're looking at for this afternoon that we can potentially get on Apple. So let's jump in and take a look here. I've got the daily chart of SPY. This is the S&P 500 ETF, and you can clearly see it has been a wild ride over the past 3 days. This 3-day stretch right here will go down in the record books for me. The 40, 50-point moves on SPY, you don't see this very often. You might see it a couple times in your trading career. And the fact that it's happened 3 days in a row, very, very unusual. And it's in direct reaction to all of the tariff headlines. Right? A lot of concern, uncertainty around these tariffs worldwide. How is it going to impact markets? And there's been a lot of headlines talking through markets are going to crash. It's time to go to the sidelines. It's time to get into cash. And I wholeheartedly disagree with that. As a trader, I want to be active. I want to take advantage of whatever the market throws our way. The beauty of trading options is we can do things in a fully risk-defined way to react to bullish, bearish markets, quiet markets, volatile markets. You don't want to get scared to the sidelines. So what I've been telling our members, turn the news off. Turn CNBC off, Fox Business, Bloomberg, I don't care what the source is. The problem there is they're all going to sell the fear narrative. Right? They're going to try to scare you to the sidelines, and they're saying, hey, go to cash. This is not the time to be active, when in reality, there's good money to be made right now. You have to be disciplined. You have to control the risk, certainly, but you don't want to go to the sidelines and miss out on this opportunity. So does this mean that we're at a tradable bottom? We had more news hit, a 90-day delay in the tariffs for everybody outside of China. And that caused just a massive move. You can see the Dow's up over 2,400 points. The S&P's up 370. The Nasdaq's up 1,600. These are big, big moves. Well, let's take a look at the technicals because we are trying to break up through this 8-period exponential moving average. That's my magenta line here on the chart. If we can break above that level on a closing basis, we could potentially get some follow through for a few days here, right? Potentially up into the 20-period SMA and EMA. Those are between 547 and 552. Those would be areas to watch over the next few days if we continue to push higher. However, if we go right back down below that 8 EMA, it opens things up to another wave to the downside. Right now, why do I bring that up as a potential scenario that could play out? I am still very concerned with what we're seeing in the bonds. If you take a look at TLT, you can see it's been another big move to the downside in TLT, trying to recover here today, but a lot's going to ride on what's going to happen with bonds. You can watch TLT very closely. You can take a look at /ZB, look at the bond futures. You want to watch those closely. If we can't get a reversal in bonds, I think we could be in for further weakness going forward. Now, when I talk about a tradable bounce, if I go back to SPY, when I talk about a tradable bounce, I'm talking about the very near term, over the next few days. Right? Are we going to see further weakness in the weeks and months ahead? Probably a good chance that that plays out. Right? I think there's going to be continued uncertainty priced in. But in the near term, I think there's an opportunity to play these bounces to the upside. I want to be open to trades in both directions. We've closed out of a lot of trades the last few weeks, and it's been a mix of both bullish and bearish trades. You don't want to fall into that trap of just going right to the bullish camp or the bearish camp and just fall into either side exclusively. You want to be open to anything the market throws our way. All right, so again, levels on the upside to watch. The 8-period EMA at 529.50. And then you've got the 20-period SMA and EMA just above us between 547 and 552. On the downside, if we roll back over, that low from earlier in the week at 481.80 would be a near-term area of support to watch. Volume's been phenomenal. I mean, the last week or so, we've been well above 100 million shares on SPY. That's great, great volume, no doubt about it. The ATR has exploded. The average true range is now above 18. in the 20 years of trading, I've only seen this happen a couple of times. It's not sustainable. In all likelihood, over the next week or so, we'll start to see things settle down a bit. The ATR will most likely start to contract. The volume could potentially start to contract. And then more importantly, look at the VIX. If you take a look at the volatility market wide, the VIX traded up to 57, almost 58 here today. That's after hitting 60 last, well, if I go back over to the daily chart, we'll take a look. If we take a look at the VIX over the past week, we have seen it well above 40, got up to 60, back down to 35 today. That's a big, big move. And we've talked in recent videos about volatility. When you get these spikes, is it sustainable to have a VIX up at 60? It's not. Oftentimes, it's going to be a spike in fear around a news event where markets price in the worst possible case scenario, in this case, around the tariffs. Now we're starting to see some relief moves, right? Now we've got the announcement of a 90-day delay in these tariffs, and that's what the market needed to get that little bit of a relief. Not a little bit. It's been a big relief move in equities along with volatility. When the VIX is up at 60, some of you have reached out and pointed this out. I mean, the options that you're looking at, the long options, are incredibly expensive. When volatility gets this high, you are pricing in a lot of uncertainty. You're going to pay up for that. That puts a lot of pressure on needing the big moves to continue. In all likelihood, when volatility starts to contract like it has here today, again, that's going to very much hurt a long option. What can we do to take advantage of this? This is why we've been using so many credit spreads with our members. I'm not opposed to taking long calls and long puts. We just have to be more selective. I want to use more credit spreads right now to benefit from this volatility contraction. That's going to cause the options to get cheaper. That's going to be to the benefit of a credit spread. That's why it's so important to have multiple strategies in your toolbox. If all you ever do is just buy calls and puts, this is an environment that you're going to struggle in. With the credit spreads, now we can start to stack the deck, put more factors working out in our favor, and get better performance in our trading over time. All right, so I think bonds are going to be crucial to watch, and then those support and resistance levels on SPY, very, very important there as well. Now, there's areas of our watch list that are incredibly oversold. A lot of opportunity here on the upside. I'm looking for more credit spreads, but that doesn't mean I'm opposed to just buying outright options. And I'm going to walk you through a trade that we put on yesterday on the silver ETF, symbol SLV. I'm going to take it over to the hourly base chart. And you'll see silver had this move to the downside late last week, and it got us to an oversold condition. I can see that on our pulse indicator. It was plotting blue and green. That's indicating price got past a 3 standard deviation move on the downside. Doesn't mean it can't continue to move lower, but I know from there, less than 0.1% of all occurrences fall outside of that range on the downside. Can it happen? Yes. Is it statistically probable? No. If I'm just paying attention to news in this move to the downside, you're saying, hey, this market's going to crash. All the financial talking heads are talking about the market crashing. I've got to put a position on. But if you separate yourself from that, and if you take a look at an indicator-based system, we just take a look strictly at the numbers. If I'm taking a look at a chart like silver, where I know that less than 0.1% of all occurrences fall outside of this range on the downside, am I looking to lean bearish? Am I looking to initiate new bearish positions there? I'm not. I'm fighting all the numbers at that point. I'm not going to get emotional. I'm just looking for a trade. Right? I'm not going to get emotional and say, hey, I'm going to look for that black swan event on the downside. I'm saying, hey, this market is due for a bounce. I'm going to potentially lean into a bullish position with a fully risk-defined trade to see, can I get a quick pop to the upside? I'm just strictly letting the numbers dictate what I do. Well, we did see this trade triggered in on Monday. We did not take it initially. We actually got in sync with the trade yesterday afternoon. It hit our entry point. These blue dots represent our entry point. And as of yesterday afternoon, we were sitting right at that entry point, which is why we came in and we bought the 26.5 calls for $1.50. $150 per contract gave me a bullish trade on silver, looking for a quick pop to the upside. Wasn't anticipating a 24-hour trade. I was fully prepared to sit in this one for a period of a number of days, potentially on out to a week or two. But this one, very quick, right? You can see silver's had a nice pop to the upside. It's up 3%. That's all I needed. We came in here today, ended up closing the position out less than 24 hours later, booked a $51 profit per contract, quick 34% return. It's $153 a profit if risking $500 per trade or less, right? Is this a record-breaking profit? It's not. Is it a home run trade? It's not. That's not what I was looking for. I was looking for a quick pop, a 34% return in this market overnight with a fully risk-defined trade. That's why I love to have these strategies at our disposal. I like to have it as a regular part of my trading. Now, can you take this with bigger size? Sure, not a problem at all. We talk about the $500 risk number because that's what fits a lot of retail accounts. If you want to bump up that size a little bit, sure, not a problem. It's a very liquid market. Okay, so really nice trade there on SLV. Now let's move on over and talk about a potential trade for the next 24 hours or so. We've got a lot of these tech stocks, a lot of these NASDAQ names that have been beat up, no doubt about it, Apple included. But now we're starting to see them come to life a little bit. And now we have some potential bullish setups plotting for us. Notice how I've got a yellow and a red dot here on my hourly chart. You can see our pulse indicator is starting to flip above the zero line. I've got this candle right here closing above our middle channel. So it gives me a bullish outlook in the near term. I'm not saying a bottom is in for the year. I'm saying over the next 2 to 5 days, could we potentially see a bounce here? Yes. If we come up and hit our yellow dot at 196, that's the level I need to see hit before I put this trade on. If that happens this afternoon into tomorrow, I'm open to putting on a bullish trade. Could I come in and buy a long call on Apple? Sure. Here's the problem with that. Let's jump over to the trade page. If I were to go ahead and take a look, let's just say we went out to May and we decided to look at buying a long call option. The problem with that, if you go slightly in the money, you're talking about $1,800 per contract, just for a single contract. And that's due to volatility being so high. When volatility gets high, the option prices are more expensive. The market is pricing in uncertainty. Well, that doesn't mean it's a bad trade, but I don't want to tie up $1,800 of my capital in a one contract position. It also only gives me one way of making money. I need Apple to make a pretty big move to the upside to offset the time decay and any type of volatility contraction. So what else could I do to put on a higher probability trade that would tie up less capital, still leave me with a risk-defined trade? Well, what I like to do on my hourly chart, with those types of trades, I like to go out between 3 and 10 days, which would have me going out to the April 17 options with 8 days left expiration. And instead of just buying an outright call, I could come in and sell a put spread. Selling a put spread is a bullish position, but take a look at what it does to the cost of the trade. Let's go out and let's take a look at the 175, 172.5 put spread. And I'm going to adjust it. Let's go up to the 177.5, 175. And I'll walk you through why that was in just a moment. So what I would be doing here is selling the 177.5 put, buying the 175 put at the same time, and it's trading for 70 cents mid price. I would be risking $180 to make 70. The first trade that I had up there on the screen, that just wasn't enough premium. I'd be risking too much to make too little. This ratio right here, I want to be in that risk 2 or 3 to make 1 range. If I risk 180 to make 70, I can live with that. Okay, but here's the neat part. Instead of tying up, $1,500 or more just to buy an outright call option, I'm only tying up $180 for the spread. That's my max risk. It's the most I could potentially lose on the trade. And I only lose that if I hold all the way up to expiration. And it goes against me the entire time. I can always close it out early and take a partial loss. But it also gives me 5 ways of making money. If I buy a long call, I've only got 1 way of making money. That stock's got to move to the upside. It's got to do so relatively quickly. With this one, I make money if the stock moves up, down, or sideways, as long as price stays above 177.5. I also make money from time decay adding up and from volatility decreasing. Right there, it takes the pressure off needing everything to line up perfectly. I've got multiple routes that I can follow to make money on this position. I like that scenario. Now, in exchange for having 5 ways of making money, I also give up the unlimited profit potential, which I'm more than willing to give up at this point, right? Because this market is so uncertain, because it's so volatile. I want a risk-defined trade, and if I have to give up the bigger profit potential for the lower risk, I'm okay with that trade-off. The most I can make is $70 per spread, but I like to target 50% of that max profit. So I'm going to take my $70 credit. I'm just going to divide it in half. I'm targeting 35 cents as my target level. If you want to use a stop, we can use a 70% stop. So I would take that 180 max risk, take 70% of it, which is $126, and then add in the $70 credit that I'm collecting to open up the position. And that would leave my stop at $1.96. If I got out there, that would leave me with a 70% loss or $126 of loss per spread. Really like this scenario. I really like this trade. Again, I need one more push to the upside on Apple to hit my entry point. So I'm not going to take this trade until I get to 196. But if that happens over the next 24 to 48 hours, this is definitely a trade I am interested in. And if I take a look, there's other names on my list. If you take a look at Amazon triggering into a long trade. Again, I'm not looking for major market bottom. I'm just looking for some potential bounces over the next 2 to 5 days. Amazon is another candidate that we could take a look at selling a put spread on. If I take a look at the NASDAQ ETF, QQQ, it is also sitting right on top of a long setup that triggered in this afternoon. This one could also be a candidate. Again, just looking for some bounces in the near term, maybe short-lived. It may just be a dead cat bounce, but I think there's some opportunity here in the very near term for a relief rally. So this is how I'm looking to play out. I'm going to go to some of these oversold tech stocks. I'm going to take a look at selling some put credit spreads to ideally play the bounce higher and potentially take advantage of the volatility contraction as well. So if you have any questions on the Apple trade or what we did on silver, feel free to post a comment on the video, and we're more than willing to reach out and help out with any questions you might have there. So I'm going to wrap this video up here. I'll be back with you guys over the next few days with our next video. All right, we'll talk to you then.
Everything discussed here is our opinion, and it is not to be taken as investment advice because we are not your financial advisor, nor have we considered your personal situation as your fiduciary. This presentation is for your education and entertainment only. Please review Netpicks' full risk disclaimer and privacy policy.